Welcome to today's podcast. Thanks for joining me as always. And here we are just trying to provide some education to empower you to think about how can you take control of your financial life and build the life you truly want and the freedom that comes with it. So, often I get asked about real estate and getting into real estate investing, and it's one of those daunting tasks for those who are just busy in their business and lives. How do I even get started in learning? And so thankfully, you're here joining me with a special guest, Neil Timmins, who's the founder of Little Guy Loans, which I love the name. We'll kind of get into that. But, he comes with us with 20 plus years of experience in real estate. So you're going to benefit from hearing from him directly, what he's seen, what he's learned, how it's impacted his life. So it can maybe help you think about what are some next steps you can take as you go along your real estate journey. And real estate can come in different forms, whether you're actually the builder, I call it, and you're either fixing, flipping properties or doing long-term rentals, whatever your focus area. But these things need capital, and someone needs to provide it, whether it's through your bank, a private lender, and so we can play on those sides. And thankfully, Neil has experience on both sides, and he helps them both those players today. And we're really fortunate to have him today to share his wisdoms and thoughts. So, Neil, thanks for joining me today.
Tom, it's good to see you again. I appreciate having me on here.
No, it's great. No, I've been looking forward to it. And, I know you just telling me before we get started here that I took a little trip, got some warmth, and hopefully as we get into the spring here, things will pick up weather-wise and even market-wise too, which always seems the case. So before we kind of get dive into, because I want to share a little to our audience here, a little bit on both sides, right? The investor operator side and share that, some of your experiences there, and then think about it as actually playing the bank, which a lot of people don't even think about that side of it, right? As a normal investor. So before we get in there, can you share our audience just a little bit about your background, kind of, obviously a long history in real estate, kind of, and how's that taking you to where you are today?
Yeah, absolutely. I'd be happy to. So about just before I got into real estate, I worked for a bank, Wells Fargo, for a couple of years in personal banking space here in Des Moines, Iowa. And then I stumbled into real estate, got in as an agent, and I'll tell you what, it just fit like a glove. I found a home real quick, rookie of the year, and within 4 or 5 years, I owned a Remax, operated a Remax, became the number one Remax agent in Iowa when I was still in my 20s. So fast forward now, I'm 22 years in the business, and I've done just about everything. Well, on the brokerage side, I brokered about 2,000 homes. I got into investing at some point here in the last 9 or 10 years, and I've fixed and flipped over 200 homes here in the area. Owned at one point just north of 50 rental properties. Now we've drawn that back down as I morphed my portfolio out of the single family space and into the commercial space. So I've been involved in nearly 24 transactions on the commercial side, and then launched our lending business here about 3 years ago or so. I'd been fixing and flipping in town for some time. Oftentimes I'd sell a property off to another investor that I'd know, and they'd be like, cool, I'll buy it, but can I borrow some money? So that's where it all started, and that's how the lending business grew out of this. Now, Little Guy Loans, my right-hand gal name in the company, we had a brainstorming session, came up with tons and tons of names. And she said, hey, we're not Wall Street, we're Main Street. We're for the average person, people out there trying to make it all happen to support themselves, their family, to ultimately build generational wealth. We're for the little guy. That's what we are. That, and then I stand almost 6.5 feet tall. So if I say it in person, it always gets a smile on somebody's face.
Hey, that's the Little Guy Loan, buddy.
Yeah, that's right. That's the little guy. Yeah.
No, I appreciate
Right.
that. And I often enough, I've come across folks on to your point, the other side, the Wall Street side and the big player
Sure.
side, the big banks and that world. And certainly I come across enough people who are distrusting of it and want to find their own path and get it back to Main Street. Right? What can I control out of all this? So this at least gives them a little bit of path.
Yeah, I think that's largely when we deal with clients, they love the idea that they're talking to a person and a person is making a decision, not some sort of computer, not something. So it's largely, we do a lot of things our word sets that bind and we back it up with all the paperwork, everything we need to do. But when we give somebody a commitment, we're going to see that thing through.
That's great. That's great. So let's shift gears. I mean, because thinking about because obviously your own properties did tons of fix and flips, and now you're on the lending side too, right? So you've seen two sides of it. But if I can compare and contrast the two in terms of risk levels, right? How would you sort of share based on your experience of what that looks like and how you see it from your lens?
From the risk levels, that's a great question. I mean, overall, fixing and flipping is riskier in all situations than being the lender. All right. So think about equity always gets paid the highest rate of return, and it's because they are taking on the largest level of risk. Now, some would argue that maybe you can buy such a deal so great that there really isn't a lot of risk. And I would agree with that. But in comparison to the lender, there's still more risk. When it comes to the lender, that lender should never lose money. They should be structuring a deal in such a way that they are ensured that they will be repaid.
Now, that seems very logical from my lens. And, I spoke, and obviously we're talking at the lower levels, but the bigger levels, there could be someone who would argue, hey, there's a lot of moral hazard in this sort of environment. I'm just going to take a risk. I'm going to get bailed out anyway, right?
Sure.
Type of mentality. But at the level you're playing, it's a different world, right? No one's going to come bail you out.
There are no bailouts. Yeah, right. We are not too big to fail, right? So we don't fall into that category. We fall into the category of, like so many of us, which is most of us, that we got to go do what we can with what we have, make strategic decisions, just like what we do when we lend out money, but also from the investor standpoint, when they're going to buy a property and go in and remodel, let's say, and resell that property, they need to be understanding the risk they're taking on and the decisions that they're making. And most guys are not going to, they're doing exceptionally well when they're doing these things.
Yeah. So on that note too, I mean, obviously you've seen good ones, bad ones. I'm sure you learned a ton as you kind of evolved your skill set and knowledge. Like what separates like some of the stronger operators? Like what are they doing instead of just chasing deals all over the place?
Yeah, the strongest operators, when they're coming to fixing and flipping, you're making your money when you buy that property. So they're spending the time to make sure they get that buy side right. And then from there, you got to manage it tight. So it is a tight time frame with a tight scope of work, because that's where I see guys just get killed, is when they're moving way too slow, or they're modifying how they're going to remodel it in the mid project. It is making decisions on the way in and sticking with that unless a problem occurs, and you just address it. But I'm saying you decide on what's that pink color, and you're not going to change that pink color halfway through the project. Well, you're going to go see that project all the way through, and you're going to deliver it for sale in a timely fashion.
Yeah, I think that just sort of lends itself to like just being disciplined and focused, right?
Correct. Yeah, I think it goes a little past that, because you need to have a plan going in. And so a lot of people, this will be their first, we'll fund some people with their first deal, second or third deal, and they're still learning as they go. And we'll have those calls. What's the plan? What are you doing here? How are you looking at this? Show me your scope of work. What's the time frame? So I have them walk me through that. So we're trying to educate them, because I know if I can improve them as an operator and add some benefit to them, we improve our position as a lender.
Right, right. Mitigate some risk on that side. Like,
correct.
Right, because they have to do as an operator, right? They're doing their own underwriting of the deal, right? They have to think, is this a good deal or not, right? And understanding the numbers, right? And has that changed dramatically at all, kind of, I guess, in today's market, right? Rates are a little higher.
Yeah. No, there's no doubt. Yes is the answer. You're right. They're underwriting a thing. When somebody comes to us with a project, it is, here's what I've got. Here's what I'm paying for it. Here's where my remodel cost is. And here's where I think I'm going to be able to resell this at the end, and what my time frame is going to be. So they've got a plan to be able to go do that, because if they didn't, I would have a lot of questions, and it's probably not the best fit, right? So they have an understanding of where they want to go and where we fit into helping them execute on their plan. But if somebody, if the number's off, or something looks a little wonky, maybe the ARV, the after repaired value, what they think they're going to sell it for when it's all said and done. We have that conversation. And I pull out the comps and we go through what the comps look like. It's rare, but we have that conversation because the last thing I want to do for a client who's borrowing from us is set them up to fail. What I mean by that is they're going to go do the deal and they'll get it all done. They'll sell it, but they'll lose money. I mean, it does not, our repeat borrow rate is astronomical. And it's because we can make sure we take care of people, have the conversations we need to have, and then be a true partner, not make things easier for them as they're going through the process.
Yeah, I mean, to your point, it's like for everyone to win in that situation, right? You're helping them win, right? Not just
Correct.
giving them a loan, right?
That's exactly right. And that's what you just said is materially different than how I think a lot of people will look. And some of that has to do with the fact that the capital in my office, we control the capital. We are this a private investment group that we've got together. We've got a fund with private investors behind us. They're entrusting and empowering us to make those decisions for the benefit of a rate of return for our fund. It's not like I'm a lone broker who's going to go get a deal to the finish line and then send them off and it's somebody else's issue. We service everything. We are intimately involved all the way to that thing closes and resells and we get paid back off.
Crazy. So what, obviously with your experience and sort of guidance for folks, maybe even reflect on some of your earlier days when you were doing this, like what are those biggest things that mostly like a flipper, what are the mistakes that they're doing that causes them to lose that money, right? And how does the financing structure fit into all of this? Like
the very first thing to get it right is you got to buy it right. I mean, that's it. It starts there. And then after that, it's managing the project. So you need a scope of work. A scope of work is simply just like a recipe for making something, for baking something, right? It's, hey, here are the 17 things we're going to do. And also, here's what order we're going to do them in. You need to know when to paint, when to put the cabinets in. Who's going to do the work? And that is a tricky one because where a lot of people get it wrong or it's become very challenging is making sure you've got a correct contractor or contractors that you're going to be working with. That has become really challenging and more challenging since the other side of COVID. There's a lot of demand for people and prices for goods and for materials and labor has increased everywhere. So it's managing there. And then on the time frame, because when you're borrowing money and you're going to borrow from a hard money lender and you're at, let's call it double-digit interest rates, it adds up. And so your ability to move in a timely fashion ultimately can help make you more money, put in your pocket, or it can cost you money because it's taking you way too long to get that project done. Knowing where your value is going to be when you go to resell it is critical. And so for there, it's pulling a realtor in, getting comparable sales. Hey, you're the 5 homes in a 8-block radius that have sold that'll look similar to yours when it's going to be done. You can get a pretty good sense for what that looks like. Where I've seen people really screw it up time is when there's like one home in a 1-mile radius. There just aren't comparables. That makes it really tough. I've seen people make the most money they've ever made on a deal when there are thin comparables. I've also seen them lose the most in that scenario. So it is best for those who are seasoned and who are, got some money behind them and they can take a swing.
Yeah, right. And that's where it gets into even within that space, some diversification. There's ones that you just are good singles, doubles instead of shooting for home runs all the time.
That's right.
And maybe being over leveraged.
You're absolutely right. And, to bring back, what do the best people do? They treat this like a business and they go in there, they know their sweet spot. They find that sweet spot for them. And for a lot of people, it's hitting doubles. How can I just clip X number of dollars, whatever it is that they're after on a deal, and then just rinse and repeat? Because if I can go and do that, not 2 or 3 times a year, but 8 or 10 or 15 or 20 times a year, well, great. I got something pretty sweet going on. Other people are the other way, though. They want to do 1 or 2 a year and they want to hit a home runs. That's okay, but it's knowing what lane you sit in and then playing that lane.
And that's it. I think it's sometimes, especially on that side, I've seen it too, even just on a personal level, where you sort of start diversifying too much and sort of getting out of your lane. That's
Right.
usually when you get punished a bit and you learn the expensive lessons.
You're absolutely right, especially when you're active.
Now I'm going to shift gears a little bit because obviously and they're connected, obviously, right? So now I'm going to flip a little bit to, what we call like becoming your own banker or becoming the bank in this case,
Yeah.
or providing the capital. And, for a lot of people, like, I don't even think about this. I mean, they're actually loaning money daily. They put money into a bank account. You're actually loaning money to the bank. And what do they do with it? They go deploy it. So it's the same concept, right?
Correct.
So now you're just going and potentially lending it to somebody who's going to use it for a productive nature of, you know, repairing a home and selling it, right? In this case, a fix and flip.
Right.
So it's just the other side of the coin. And that's how I started personally. I didn't get into real estate investing. I knew I didn't know anything. So I just said, what do these people need? Just like you identified, money. I had money, had no idea what the hell I was doing. So I got around people who knew what they were doing and I paid to be around them, right? And I loaned them money
Yeah.
so they can do their magic. And it worked out really well in that respect and got me in the game. So obviously we talked a little bit about the risk profile of this, right? The lending versus the owning. So by and large, the lending side should come, if you're doing this right, should come with less risk, right? By,
Absolutely. Correct.
by and large, right? And the way that I know in your world, just the position, I know within how you guys are securing loans and applying to properties, it's like in first position. And what the heck's that actually mean for people?
Yeah, great question. First position only is how we lend money, which means that in the event that there's a problem, they default, they stop paying us for whatever reason, something goes sideways, we're in first position through a mortgage or deed of trust, depending on what state we're in, to be able to go take that property back. So the scenario there is if we had underwritten the property correctly and the person correctly, and we've got boxes that people just sit in, they're stroking money for down payments when they're buying these properties, is that us taking the property back shouldn't be the worst case scenario because there is a chance, which by the way, we've never had to take the property back. But in the event we do, there may be a chance we actually make more money by virtue of taking the property back and disposing of that versus just collecting and getting paid off in normal.
Yeah, and this is where which again, going for home runs, like there is place for that, right? And the asymmetric risk, all those sorts of things, I get that. But in this scenario, there's, I think a lot of smart investors, there's always a hedging aspect to it for the most part, right? This
Sure.
one's built right in. It's the house, right? It's the asset,
Right.
right? As long as you're underwriting it properly, to your point, there's a lot of outs to this, and hopefully protects yourself and investors and involved, right? As long as you're looking at it properly, right? And that's why it needs people who know.
100% right. Yeah, it comes down to proper underwriting. And like I said, fortunately, we've never had to take a property back. We've had really good, strong underwriting standards, and we're always constantly reviewing. Our average credit score for somebody that we lend to is north of 700. So a lot of people come to us not by virtue of their inability to go to a bank. It's because of what we do that's materially different than what a bank can do. We move much faster. Our average closing 16 days from the day we get a contract to the day we close. Banks just couldn't hit it. We are absolutely more expensive than a bank, but we move much simpler, much faster. We deal with the dented and scratch space because those are the assets that we understand exceptionally well, just given the background of what I've done and my team's done. And so we can help that and add value to an investor past lending them money. So I think arguably, we can give them some value past of what a bank can give them just because of our, what we've done, what we've experienced. I always say there's, you open up that wall either figuratively or literally. I probably ran into the problem and I probably solved it somewhere along the way.
From lending, and then we touched on this a little bit earlier, and I'm sure this is the care you take, is to, sure that the loan to value, whatever you're loaning, there is some cushion there, right?
Correct.
Obviously, there's projections and such, but cushion there because things are going to go wrong. Nothing ever goes perfectly, right? And maybe some scenarios, but rarely, right? So you're already sort of baking that in. Can you talk more how you guys kind of think about that?
Yeah, you're right. Because especially when you get into the construction, that there are phases of construction, almost nothing ever goes to the exact plan. And so we're building that in. Yes. So what we'll typically do, or we'll lend up to, how about, the most, if you will, we will lend up to 90% of the purchase price, up to 100% of the rehab costs, so long as that we are at 70% of the after repaired value. So meaning in a house that's worth $300,000, when it's all set and done through our loan, we need to be no higher than $210,000. We build that cushion in. When they're going through the construction process and they're doing draws, they submit back for us, hey, we need a draw request for whatever, $10,000. And here's the work that was done. The kitchen cabinets are installed. Great. So we go out there and physically inspect the properties and, in combination with pictures that we get from the guys who are submitting the draw request. So we're actually on site reviewing this, want to understand what work they're doing through the entirety of the process.
And you mentioned you haven't had a default, huh? In any of the properties that you've mentioned?
We've had two defaults, but we've never had to take a property back. So one of the two defaults just paid off about 2 or 3 weeks back. We're in the middle of our second default now. So hopefully, we're going to see how that goes. We are at about a 38% loan to value ratio on this thing. So we are so far off of what's owed compared to what the property's worth that I think it's simply just a matter of time before we get paid back, because no borrower in their right mind would let us take that property. Right. And that's not our intent either. The intent ideally for us is keep that thing running and bring them back as repeat clients. But once in a while, as personal life gets in the way with some of these folks, and we just got someone who put other things, other priorities ahead of ours.
Yeah, right. Yeah, and that's the thing. I mean, I've heard that from others too. It's God thought of loaning to somebody to buy a home is scary. And I said, well, if you don't know what the hell you're doing, yes. Right. Right. And you don't have a clear line of sight of what could happen if they do not sort of meet their obligations. You clearly have a way to deal with it when it defaults. Right. And have
absolutely right.
backstops
Yes.
to making sure that, chance of losing money is almost zero or very close to it.
I mean, that's the intent, is to underwrite these things in such a way that we get it down as close to zero as conceivably possible. The intent. What did Warren Buffett say? Rule number 1 is to never lose money, and rule number 2 is to never forget rule number 1. I mean, if that's not a banker's plastered, almost a tattoo, I don't know what is.
I know. So when we look at this, and obviously you went through the front end, actually the builder, there is some significant risk there that probably seems like a little bit, maybe more some upside, but you're taking on a heck of a lot more, right? As the owner and operator in that sense, then who's better suited for the lending side versus operator? Like from your lens, you're seeing them maybe both sides, how would you describe that for the folks considering it?
Yeah, for they're considering it, what type of person would go down one path versus another. If you're close to real estate, you have some sort of either you're an agent, maybe you're that close, and that was my forte into investing, is that I was an agent. I'd walked, at the time, several thousand houses. I got a pretty good sense of what a home's worth in as-is value and what's it worth after the fact. And then I filled in the gap of my knowledge with going and finding contractors, which required striking out multiple times until I got the right one. I had a couple dollars in my pocket, so I had a backstop of funding my own thing, not borrowing to get started. And I think that is critical, because when I deal with people today where they literally have no money and they want to borrow 100% everything, there is no margin for error in that thing. It really becomes a tough spot. So if you're close to real estate, you can understand, or you're a contractor, somebody understands how to fill in the process there, and they want to be active, which they must want to be, because it is absolutely active. That's a good avenue. On the lending side, I see it one of two ways. It is that they have some sort of affinity for lending. They like the numbers. They like talking to people. Again, it's active because we're doing work, talking to people, seeing projects, underwriting deals. There's a little team here that gets this thing to go. So it is also active. It's just a different kind of active because you're not swinging hammers. You're not dealing with those contractors. You're dealing with a single borrower and underwriting details. So who do I see get into that business? Typically people who have come out of industry, all variety of industries, and they've got money behind them and they want to go deploy their own capital and they want to be that close to it. The other one I see, the other way I see people participate is they want to be their own bank. They want to control their investment decisions. They're kind of, have enough exposure to Wall Street. They want some diversification. They're a busy professional and they link up with somebody like what I do and they become an investor in what we do. That's how they participate.
Yeah, that makes sense. That makes sense. Yeah, and I think about it too, even, broadly speaking, because most people are more sort of obviously familiar with the public markets. So obviously this is a private, right? This is a Main Street sort of thing. So it is already adds a lens of like scariness to most people because it's just not available in my 401k, right? And it does require a lot of activity. And so even when you think about it from your lens, again, this is not any financial advice. So put that out there. Like how do you see this fits in? How does this fit into most people's like diversified portfolios if you kind of think of it broadly, right?
Yeah, well, you think about it, it's truly private credit is the avenue that it fits in. That's the asset class that one's in. And, for us, when we get bring investors in, guys are getting paid 10 or 11%, depending on their level of investment. And on a cash flow basis, meaning they're getting distributions every quarter, it's really tough to get that kind of exposure or get that kind of risk return in a public market. Dividends are sharply less than that. And so if they can get comfortable with, hey, the business of, hey, we're just a bank, but without being a bank, right? We operate much like a bank. And instead of giving depositors 0 and lending at 7, right? We give depositors double digits rate, depositors, I use that in quotes because they're not really busters, but investors, double digit rate of return, and we lend at a higher rate of return.
Yeah. Well, I forgot who said it. It was said banking's necessary, but banks are not. I don't know if it was Bill Gates or somebody said, right? So how you finance,
Absolutely.
we need capital to fund these types of projects, but you don't necessarily have to go to a bank, right? And we see that a little bit more these days. As you know, banks are tightening up and things are getting a little bit scarier out there. Capital is not as free-flowing as it used to. We're starting to see
That's
that.
exactly right. And that's why so many places like us, like what we do, operate, they live and thrive on a very hyper-local basis because they understand the borrowers, they understand the real estate that's there. They're very attuned to what's going on in that local environment.
So what, from a private lender, I mean, not going through you guys, but just in general, like, what are some risks that they don't really think about, right, that they should to get into private lending, right? That they should really understand before they do it.
It largely goes back to a couple of the pieces that are the same skill set as those who fix and flip. Understanding the numbers. What am I buying it for? What do I rehab it for? And what am I going to resell it for? And all those 3 numbers accurate. Because if they are, great. And then you've got a deal, you've got an opportunity. Now you need to underwrite that jockey, because can they get it to the finish line? How do they manage that? Are they trustworthy? What's their past history of doing projects? What's their past history of paying people back, right? Which is largely reflected in a credit score. Do you pay people back as you say you're going to?
Yep. Yeah. Yeah. And that's the thing. I think that it's to your point, like even if you're doing that, there's some level of activity. People are always hunting for, how do I passively make money? Do nothing. Do as little as humanly possible and make money.
Right.
And I said, smart investors still have to be active in some ways. This is how you're active, right? And thinking about it.
Correct.
Or like you got to the passive engine of just to put it into an index fund and kind of wait 30, 40 years, right? That's kind of what a lot of people are trained to do.
Yeah, it's ultimately reflected in some of the rates of return, isn't it?
Yeah. And so a couple of things. The last thing I want to think about with this too, because on a plus side from a public market, a lot of those things you can just trade them very quickly, right?
That's right.
That's really, to me, there's, the pros to that is the liquidity is high. There's people that will buy your stock, whatever. So there's a benefit to that. I mean, for deals like this, what does the liquidity sort of environment look like? Like, what do I,
12, yeah, 12 to 18 months.
12, 18 months?
Yeah, let me be more clear. When somebody comes in and they invest with us, they need to be in for at least 12 to 18 months, and then it's a 90 days heads up after that. If you cross a certain threshold, I think it's $500,000, it's 180 days. So it's just, we got money moving and cycling because mortgages are routinely getting created and paid off. And so when we create that liquidity, that's when we can get distribution back to somebody.
Okay. Yeah, so it's just good to know around these things. I mean, obviously, we talk about on this bias a lot, just making sure you're purposeful with your money and where you're allocating it. Unfortunately, I've come across way too many people where they're completely illiquid all over the place. And
Right.
it's just, then they're forced to sell type stuff. So knowing where that is in your sort of broader financial life is so key, right? Especially, if you need it soon. This is not the place for it. Right, there's a lot of places that are not for it. So anyway.
Correct. Yeah. You're absolutely right. Yeah, it's critical to understand that. It's critical to know who you're doing business with, especially in a scenario like what you and I are talking. When you get into those private investments, it's understanding who's that operator. Well, what's their track record? What's that history like? How do they do things? It's understanding them. You got to get really comfortable in order to make that decision to move forward with somebody.
Yeah. And it's like I use these financial terms, I don't know, capital stack, always hear like, what's your capital stack, right, look like? And, you got to know that for yourself, right? And how that fits into kind of your lifestyle and what you're trying to achieve. And that's why it's so key. So, I really appreciate you sharing so much around both sides of the fence here. And I know the listeners got a lot out of it. So, I do want to ask you to share how do more people learn about what you do and what your company does for not only the investors who are trying to do fix and flips, but people who are just trying to maybe loan money to appropriate real estate deals. How can people sort of learn more?
Best way to learn more is littleGuyLoans.com, and then just the About Us tab there. And there's a couple of different tabs there where you can learn about us and learn about what we're doing.
That's wonderful. Wonderful. Well, Neil, I truly appreciate it. It's, I enjoy talking to you all the time, and thankfully this is a start of good things, more things to come in the future. But I appreciate you coming on and sparing your time and wisdom with us.
I appreciate having me on. Great questions, and I appreciate the work you're doing to help improve people's financial lives. So thanks for having me here.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.